Yeah, we're relative. An interesting space. Yeah, it really is, and I don't fully understand. Well, Birdman's on you. There you go. Hi, Bird.
Hello, everyone. My name is Katie Kamahi-Eva, and I'm Doug's executive assistant and also help with our marketing and events here at Sterling. So Lance Stafford is our speaker today, and he's the senior director with the strategic group. He'll be providing an overview of the Qualified Opportunity Zone program created by the Tax Cuts and Jobs Act of 2017. He's going to talk about the tax incentives created by the Act and the potential impact on commercial real estate development inside of opportunity zones. Lance works closely with tax professionals and other financial advisors to provide tax planning and mitigation solutions for high net worth investors, family offices, and corporate taxpayers. Mr. Stafford brings over 20 years of capital markets experience to the strategic group after managing the equity sales and trading operation in the Southeast for several investment banking firms and subsequently advising the high net worth investors at two prominent wealth management firms in Atlanta. A CFA charter holder, Mr. Stafford graduated from Emory University with a degree in economics and earned an MBA from the University of Texas McCombs School of Business. He currently serves as chairman of the board at Hillside, Inc. and is a member of the Piedmont Driving Club and the Ansley Golf Club. Please welcome Lance Stafford.
Thank you, Katie. That was more of an intro than I expected, but I appreciate it. Sounds like I've done a lot of things. I appreciate you guys being here today, and for Doug, who just texted and said he's on his way in, inviting me to speak today. I joined the strategic group in October of last year. Just a little bit about us. The strategic group was founded in 2007 by Ricky Novak and James Freeman, who were two tax professionals at Deloitte before they left to start their own business. This started out as a 1031 exchange qualified intermediary business. We still are in that business today, but we've expanded into three other areas, mainly opportunity zones, which we'll be talking about this morning, federal and state tax credits of all sorts. We are a big intermediary and broker of film credits in Georgia. And then we've been in the conservation easement business for quite some time. We've executed over 100 partnerships in that space, which is controversial at best, as the attorneys smile in the room, and is an evolving space which could have a whole breakfast on its own, probably a whole day to talk about conservation easement investing. But in terms of our opportunity zone business, I want to provide two things this morning, an overview of the program and where it stands today, and we'll use one of our funds as a case study to highlight how that program is being implemented in the marketplace in 2020. So the Opportunity Zone program was created by the 2017 Tax Cuts and Jobs Act. As Katie mentioned, it's been a very slow capital formation since then. It was designed to provide capital to underperforming and disadvantaged neighborhoods and geographies across the country. There's 8,700 opportunity zones that were identified by the state governors in accordance with the act. Georgia has 260. That's right. Oh, there we go. But to give you a flavor across the country, those 8,700 are spread out across all of the states. Georgia has 260. Not at last count, but that's how many the governor designated. So we have our good fair share in the Southeast. Our funds are focused in the Southeast and up and down the Eastern corridor. But going back to the capital formation piece, there's been a slow roll, and we'll talk a little bit more about this in terms of how people access the market, because the legislation wasn't very well developed when it was announced. We've gone through 3 revisions and clarifications of the legislation itself. The last one was passed muster in December. We think that will be the last round of revisions. So now we think we have a clear view of the market, and we think the next 6 months will be pretty active in terms of capital raising. If I take a look at what's happened to date, disclosed capital raising in this business has been about $6.7 billion. You'll get the Secretary of Treasury, the President will tell you that hundreds of billions of dollars will be committed to this program over the life. So we haven't seen as quite a robust entree into the space as people expected. But again, we think that will pick up. Our pipelines are starting to show more interest and more actual execution of both fundraising and actual construction inside of these zones. I don't know. I think, Carl, we were talking about the State of the Union address last night. One of the first highlights that President Trump made was the Opportunity Zone program. It had Tim Scott from South Carolina stand up and be recognized for the work he did in terms of inserting it into the legislation. So it's certainly a great program that's been slow to get off its feet. But at the end of the day, it allows investors to gain significant tax benefits from taking capital gains that they otherwise would not realize because of the tax impact of taking the gain and providing some liquidity and diversification in their personal portfolios. The Act's designed to incentivize that in 3 ways. One, taking that capital gain and deferring it to 2026 tax year. So the first benefit is you can go ahead, provide liquidity, take a gain in any type of asset. So it's very broad in terms of the type of capital gain you can apply to the investment itself. So you can have a portfolio gain in a traditional stock and bond with a low basis, or you can sell a company, you can sell other types of assets. Anything that's generating a capital gain can be applied as an investment into an opportunity zone fund. So you defer the gain, then you're reducing the capital gain. We just lost one of those benefits partially because in the beginning of the program, if you held the investment for 7 years inside of the fund, you get a 15% reduction in the actual gain itself. But that came in 2 stages. One was 7 years and one is 5 years. So as of January 1st, we no longer have the 7-year window to get to 2026 for the first reduction in the capital gain itself. But we still have the availability of a 10% reduction if you hold it for 5 years inside of the fund. And then really the biggest tax benefit is the tax-free appreciation of the asset itself inside of the fund. So if you hold the asset once it's invested for 10 years, and the program has been extended through 2049 now, you'll get all the growth on the actual investment will be accrued to you tax-free at the disposition of the asset. So we think that's the big bite in the apple for investors because you're trading off holding period risk for tax-free appreciation on what should be a good investment. The program does not make bad investments good, but it can make good investments great. So one of the key things about thinking about what type of projects to put inside of an opportunity zone or what type of projects to invest inside of an opportunity zone fund is, are they good on their own? Do they stand alone as an investment with some good tax benefits on top? Right. So I think the rush to market had a lot of single project deals, and we'll talk about that, where commercial real estate guys saw an opportunity to take cheaper capital and find investors and go do single projects. And that's been tough for advisors and tax advisors to get their arms around because it just adds too much risk to a person's portfolio who may or may not have the right type of real estate experience to understand the risk they're taking. So those are the tax benefits. And feel free to stop me at any point if need clarification on any of the tax benefits or other issues that we're addressing today. The other big thing is you have to invest that capital gain within 180 days of taking the gain itself. So there's strict timing constraints across the legislation, and the first one is that 180-day window for the recognition of the gain. And there's some slipperiness to that because if the gain's taken inside of a partnership, it's likely that the clock would start at the tax year end of the partnership itself. It's a pass-through entity. But for simplicity's sake this morning, let's just say you have 180 days to invest the capital into an opportunity zone fund that's qualified and has the appropriate regulatory requirements requirements filled for the tax advantages to apply. So that's the first key date. Once the funds are invested inside of a fund like we run, we have another 6 months to invest the capital, again, to maintain tax benefits. And then there's testing that has to occur along the way, which is part of the issue is you have to maintain benchmarks of success, right? So these are properties that are located in areas that should need substantial improvement, right? So you can't buy a piece of land inside of an opportunity zone and hold it and then sell it in 10 years for the appreciation of the dirt, right? You have a 30-month window to make substantial improvements to the property. Or if you're investing in a business inside of an opportunity zone, the business has to meet certain hurdles in terms of working capital applications and commitments themselves. So the timing aspects are very important, and they're somewhat hard to understand in certain respects. They're pretty straightforward in others, but if you miss them, you can really blow up the tax structure pretty easily. So in terms of accessing, and again, this morning I'm addressing this from an investor's point of view. There are three main ways people have been accessing opportunity zone investment opportunities. One is the single asset fund, which we've talked about a little bit, where it's just one project, commercial real estate guy finds a deal, and he goes and tries to fill it. And he puts it in an opportunity zone and goes and says, hey, this is a great opportunity. It's a good project on the west side of Atlanta. Let's find equity partners to join us. And they use leverage, and they do the things real estate developers do. Very traditional approach, just a different wrinkle with the opportunity zone. The issue is, A, lack of diversification. B, you've got to have a real estate developer who understands the code and the law and can get you through that 10-year holding period, right, without blowing up the tax structure. Couple of issues. One, there may be a conflict of interest there, right? Because the real estate developer has a much narrower, typically has a smaller, shorter window than 10 years. So the project gets done, you make substantial improvements. 3 years later, you've got a nice exit, right? But you have to manage that exit well to, again, maintain the tax advantages for those equity investors that came in. And the real bump in the IRR, right, is in the substantial improvement. So your valuation is going to improve the most substantially during that period of time when you're improving the property. And then after that, you can get market rates of return on the yield for holding the property. So there's issues with that in terms of, is there a conflict of interest between the developer and the actual equity investors? Are their timeframes mismatched? The holding periods mismatched? And who wins, right, when it comes time to cash out? So that's one of the issues with single asset funds. The others are related to risk in terms of diversification and the actual underwriting of the project itself. The other way...
Hey, Doug. So sorry.
No problem. The other
6 years of doing these, it's the first time I've ever
no problem. Hopefully, I don't think you missed much.
Yeah, everything's good.
So the other method that was, the other type of fund that was brought to market after the legislation passed were multi-asset blind pool funds. Mark Teixeira, the former Georgia Tech baseball player, was out there. Scaramucci at Skybridge these are intended to be multi-$100 million funds. They thought they were going to be great liquidity event creators. I can tell you they've all pulled back. Scaramucci's fund's much smaller. There's now 2 of them. Capital just has not flowed into these types of funds as rapidly as people thought they would, because there's a different issue, right? So blind pool is, you give me capital, I'll go find projects. It's tough to get your arms around that if you're committing institutional money for sure, but even for the high net worth investment space, right? The advisors and intermediaries that work in that space are saying, I can't give you money and not really know what you're going to do, right? Because no one has any track record. It's a new program. These are new funds by definition. There's no track record to say, hey, we're really good at this. Opportunities in investing, we go into these tough neighborhoods and we have a great track record. Very few people can actually say that from an institutional point of view. So these types of funds really have not taken off in the way people thought they would. They may still, but I think you're going to need more traction and more track record in an organic way before these massive funds will really become successful. The program's got to kind of prove out, right? And so the last way And really where we come down as a firm, as an investment firm, is in multi-asset opportunity zone funds, right? So these are designed or more resemble traditional mutual fund. They're Reg D, they're private placement vehicles for the most part, because these are all accredited investor structures. But a true multi-asset fund actually has a strategy, has a story, and preferably has the projects lined up. So when you're committing your capital to the fund itself, you know what you're getting, and hopefully, if it's structured correctly, you'll get diversification across project types and geographies. So you're not taking that single project risk. You're not taking that wildcat risk that many real estate developers like that, right? We want the big returns for a single project we know we can underwrite and get our hands around. But for a diversified investor base, people who just, the intent of the legislation is to unlock capital gains in all kinds of asset classes. You really need something that's a little more structured, particularly with a new fund, a new investment vehicle that's been created by the Tax Cuts and Jobs Act itself. So we think this is what you're going to see. And we'll talk about our fund in a minute as kind of a case study to flesh a lot of this out. So to summarize, well, let's go through this. So this is what we see as the advantage of a multi-asset vehicle, right? So it also deals with the real estate developer and conflict of interest we discussed. So if you're dealing with a single asset fund, right, you see the substantial improvement is in that first piece, right? When you're improving the property over the 30-month window that you have to do that. And then you're going to get market rates of return after that. So a couple of problems. If it's a bad investment, right, there's no growth. This is assuming that, you know, it's an actual good, well underwritten deal, which, you know, we would hope any good investor would be making, but it does expose you to that risk. But let's assume it's a successful project. You know, then you've got to hold it through the 10-year time frame to get the full tax benefit of the program. In a good multi-asset fund, you're going to be able to take this, and they've clarified this recently in the last round of legislative updates. You can recycle that capital. So this is basically assuming all the assets get invested on day one, and then we have successful transactions of selling or recapping these buildings. So basically, you're taking your capital, distributing out the gain in year 2 or 3, right? And then you get to reinvest that into the next opportunities of investment. So it creates, some cash flow in the meantime, because we're distributing these gains back out, but you're maintaining the benefits of deferring the capital gain to 2026. You're reducing your capital gains along that time frame, and then in the end, you get the bigger cash-on-cash returns because you're getting the tax-free distribution of the actual results of the invested asset pool at the end of 10 years, right? So it's a great program. If you structure your investments the right way, it can lead to substantial capital appreciation for the investors. But remember, there's 3 sources of return really in these deals. One, there's the tax benefit, which isn't worth the investment if it's not a good investment. So there's the actual return on the invested asset inside of the fund. And then there's the social impact. So we always want to remember that there is a legislative intent and social good being created by the program in theory, right? I think a lot of legislators are starting to attack it because there are deals being done on the west side of Atlanta, for instance. May or may not be benefiting disadvantaged citizens, right? It's already kind of there. It's low-hanging fruit. I think we're working through that right now. And I think as those players kind of get the low-hanging fruit out of the way, you're going to see more activity in areas that are really behind the intent of the legislation itself. So we run a fund called the Strategic Rivermont OZ Fund. We have a co-manager in Raleigh-Durham, which we can talk about if you'd like, but just for brevity's sake this morning, it's a co-managed fund out of Raleigh. Again, Strategic Group and Rivermont Capital partner together. It's a diversified multi-asset fund, which we just talked about. And our real competitive advantage is through public-private partnerships that our co-manager brings to the table. He renovated a large part of downtown Durham in the early 2000s and had projects in its pipeline when they pass the tax cuts and jobs Act. So it gives us leverage. We have that identifiable pipeline of qualified projects to offer to investors in multi-asset class fund. So we think that's our competitive advantage. I only say that and bring this up, if you'll indulge me, as a case study this morning to talk about some of the other issues that the legislation is supposed to address. And hopefully that overlaps with some of your businesses. So we focus on downtown areas in tertiary and secondary markets across the eastern seaboard, up and down the eastern seaboard, that have city centers that are underperforming their economic potential and really need revitalization from a real estate perspective. So these are markets that don't have a lot of institutional money already in them. They really do match up quite well with the intent of the legislation. And so as capital is invested in these funds and in these projects, you really are creating real economic impact for these communities, which is, again, why the legislation exists and why Tim Scott got special recognition last night by President Trump. So just two examples of the type of projects that opportunity zones are really designated for. One, our first project's a hotel in Manchester, New Hampshire. So it's going to be a true hotel by Hilton. This project's already in the works. There's other pictures at the back end of the presentation that shows the progress. But Manchester is 35 minutes north of Boston, or 35 miles north of Boston. It's probably an hour and a half given traffic. People are moving businesses across the state line because of there's no state income tax in New Hampshire and other issues that we can talk about later in terms of politics, but let's just assume people went out of the Boston area. Manchester woke up and said, we don't have enough hotel capacity to manage the visitors to these businesses, and our downtown still needs a little bit of work. So what they did, this is a perfect example of a public-private partnership. They donated the land that the hotel's sitting on, and they committed to building the parking garage, the parking deck, which is a substantial piece of the capital commitment, right, in building a hotel. So with that support, with some tax credits and some other incentives, we went in. That lowers the cost of capital for the developers. It lowers the valuation risk to the investors. And we're in process of making improvements to that property, so it's on track to meet the 30-month window. You know, we underwrite to typical real estate multiples, and we expect to exit that property at the end of the 3-year time frame, and we'll return capital to our investors more than likely. The other project is a little more interesting for us in the South. It's in Fayetteville, North Carolina, which is near Fort Bragg, which is really the economic engine behind it. Downtown is kind of blighted. Our co-manager knew that they wanted to work on a baseball stadium. People are going, why do they need a baseball stadium in Fayetteville, North Carolina? He said he wanted to build a baseball stadium. So we went in and said, don't build that baseball stadium out near Fort Bragg, in between the city and Fort Bragg. Your city needs some help. Build that right across from downtown City Hall. Right? And so they said, okay, they did the feasibility study, and this takes several years to get this stuff in motion. They built a AAA ballpark. Houston Astros signed a 30-year lease. And again, the city committed to building a parking deck that contributed the baseball facility to the project. We had the air rights above the parking deck to build another hotel in this instance, which will be a Hyatt. And then the master plan is a mixed-use development, retail, and multifamily. So this is another great example, and this is really a great example of what it's supposed to be. This is going to be Fayetteville's Battery, right? And so the property price improvements have already started. We've already seen the property, the collateral properties around there appreciate. You're creating jobs for the local citizens. You're creating multifamily space for millennials who like to live in multiple downtown areas. So you're really creating and revitalizing a downtown area when this whole project's done. So, you know, again, I bring these up as examples of what the legislation intended to do. Is revitalize neighborhoods and areas in urban locations that really need some help, and rural locations, by the way.
That developer's not an MGB developer.
Pardon me?
You don't know who the developer is?
I don't know the development.
They source a regular real estate developer to invest.
Yeah. Oh, yeah, yeah.
Pretty sure I know who's
Really?
doing that.
Interesting. Yeah. So, yeah, we work with those local developers as part of that framework. So we're we're putting, and I'll talk a little bit about that in a minute in terms of compliance and regulating the process. So for us, this is the pipeline of deals. So you can see the communities that we're going into and the types of projects. So in our investment vehicle, again, a multi-asset fund, you're getting we're doing some multifamily, we're doing affordable housing, we're doing hospitality, light industrial, in areas that are perhaps a little bit off the beaten path from an institutional investment perspective. And you can see the types of investments that we're making. So you can make a substantial impact on these communities through the opportunities and investing process. Here's some more. This is just some due diligence framework in terms of how we're making progress in Manchester. So it's a really neat story. You can see the progress. So, the important part here is you do have that 30-month window to get the substantial improvement done. And the way we accomplish that is through a couple of partnerships, which I wanted to include this slide because it may overlap with a lot of things that people are doing in this room in particular. So for our fund, we are using Cushman Wakefield to do third-party underwriting of every deal that we consider for the fund itself. So from a compliance perspective, the investor is getting protected because those local guys have done their underwriting, and our guy in Durham's done his underwriting, and we've done our underwriting from an investment committee perspective. Then we get a third-party real estate expert to come in and pencil it. We think that's important because these are neighborhoods that haven't gotten a lot of traction. There hasn't been a lot of investment being made in these areas in quite some time. So they are more difficult projects that may not take. The banks may not walk into these places and go, this is a great deal. We have to be investors. And then CBRE, CBRE is our master planning kind of third party, which is important again because a lot of the local guys that are doing deals and real estate developers and the rush to the market didn't take this necessarily into consideration. Is how do you manage this process and maintain these tax advantages, right? So we have CB Richard Ellis, who's kind of our master project management affiliate on these. When the deals are in the dirt, they're there making sure we're meeting the requirements of the legislation. So making a substantial improvement to the property, meeting the commitments in terms of timing, and making sure the projects are done the way that they're presented to get the preferable treatment inside the opportunities. So, that's, if I had one message in terms of how the market's developing, there's a lot going on. We talked to a lot of tax advisors and other CPAs. They're saying we talk more about opportunity zones, or we have been talking more about opportunity zones than a lot of things we can remember in recent memory, but there hasn't been a lot of action. A lot of people want to do them, but no one's doing them yet. So we think we're on the cusp. If you think about it, given the 2026 first deadline for the tax benefits, right? You really want to at least get the 10% reduction in your invested capital gain basis. We would think 2020 has got to be the year that it happens, or it may not happen. But we do think there's robust demand that's been developing. There's pent-up demand. There's certainly supply of fund vehicles. There hasn't been as much supply of capital as people expected, but we think that's coming. And so we think it's going to be an important space to keep an eye on in 2020. We're actively raising capital, but there's certainly going to be many other people raising capital in the space. And so for real estate developers and attorneys and insurance guys, surety guys in the room, keep your eye on it because we think it's going to be a growth industry for the time being.
What's your entry point? What's your minimum investment?
Our minimum investment in our fund is $250,000, but pretty flexible, right? So if you look at the PPMs, our private placement memorandum, we started at 500, so we're not immune to the industry trend and statistic, right? So we're trying. Part of my job, frankly, is to get us through some of these hurdles. If we can get to 10, we can get to 50 million, you can get to $100 million, then you can do your second fund, which will be important, right, for the industry because if we're going to start distributing capital out in the form of gains, and you're still committed to fund one, let's say, then you're going to need the industry to be robust because you can take those gains and invest it in another opportunity zone fund and continue to defer those taxes, continue to reduce your tax liability, and continue to invest in assets that that will appreciate on a tax-free basis through 2049. Right? So the program is designed to have legs. And we can talk about the risks, right? So the risk to the program itself is that one of the presidential candidates that wants a 50% capital gains rates gets elected, and in 2026 you're paying not 23.9% effective capital gains tax rate, you're paying 50. Right? That's for another breakfast to talk about the likelihood of that happening. I hope it doesn't, knock on wood. But so this is not a risk-free program because you are locking up money. Right? There is a holding period requirement that the types of capital, frankly, that this opens, it democratizes real estate investing in a way, right? So you're having a different investor base come in, so that holding period is a big issue.
Who handles the oversight? Is it like HUD, or is it self-policed, or is it a look back by the IRS?
The IRS will be responsible primarily, right, for the tax compliance piece. So you really have to have that locked down. We spend a lot of time doing things like adding third parties to the list. We obviously have in-house tax expertise at the strategic group, which is part of our value proposition in terms of our fund management. It's going to get hairy and complicated. There are certain boxes you have to check on your tax forms, and so your preparer has to know how to make sure you're preserving your rights to the tax benefits of the program. But again, most of that, your tax preparer can do everything right, but if the sponsor and the actual developers inside that are committing the capital don't maintain their end of the bargain, it's all for naught, right? So the worst outcome you can have, right, is to do one of these single project deals anywhere, right? The low-hanging fruit stuff, and you think, I've got a great deal, I'm going to get a nice real estate pop. It's a nice diversification play. And then the developer says, if I get a bid, I'm going to hit it. And that's great. You may actually get a nice return on the capital, but you're going to have tax impacts that you didn't plan on. And really, who's left, the developer's guy out. He's out, right? He's done his job. It's what he does every day. It's how they think about the world, right? So you have to make sure those conflicts of interest are unwound before you commit to capital. So it's going to be interesting as some of the early projects come to fruition to see how that compliance end works out.
What are some of the other secondary cities that you all have identified projects in?
So we've got, go back to that slide. So our co-manager, after he did this Durham renovation, the state was so impressed with it, he ended up doing about 1.6 million square feet of renovation in downtown Durham, and is widely credited for creating a walkable downtown. And if any of you were in Durham in the early 2000s, it really wasn't. It was kind of blighted. I mean, and he had a tough time raising capital locally because people were like, I don't want to give you money to invest in a building where someone got killed. You get murdered in downtown, right? And so that's really what the intent of the legislation, again, is to accomplish. So he did this before the legislation was in place, and the state was so impressed that the University of North Carolina wanted him to come work for them. And he ran something called the Development Finance Initiative at the University of North Carolina School of Government. So he was consulting with all of these similar-sized cities up and down the East Coast, and these are some of the projects that are resulting from those collaborations. He caught some heat when he left the university, right? Because other real estate developers were like, wait a minute, this guy is he's monetizing relationships he created to work with the government. But I think all of us in this room know that that's how you get real estate deals done. Sometimes it's who you know and how you get there, right? So they cleared him of all that. It was kind of a big ballyhoo a couple of years ago. But these are some of the projects that have come through that work. So Asheville, North Carolina, Danville, Virginia, Morganton, North Carolina. I don't even know where Morganton is. I've got some North Carolina roots in my family. So, Gastonia. So you're looking at those types of cities, and typically this size of project. So we have a $100 million fund capacity, and we want to have 10 projects inside of that fund on a consistent basis. It'll take a little while to get up and running, but the way we've structured the fund and the way we would suggest people think about this world is, if we raise $50 million in the first quarter, we could put that to work. You can see kind of where it's going to get to work, but it's going to get us sequentially, right? We're going to meet our capital commitments to the Manchester Hotel and Fayetteville. We're going to move down the line, but eventually an investor their dollar gets diversified across those projects. So you're not exposed to just the Manchester Hotel. You get the benefit of the full menu of projects inside of the fund, which again you don't get in the single asset fund approach, and in the blind pool approach, you don't know where the next dollar's going. Presumably they've got a lot of boots on the ground trying to find those deals, but again, it's been tough for the advisory community to commit capital to blind pools. So that's the last I read, I think Scaramucci, which is Skybridge. I mean, he's chopped his down. I think it was $1 billion fund, and now it's $200-300 million funds that he's trying to create stories around. So, and that's not saying anything bad about Scaramucci. It's just that tells you how difficult the market's been relative to the expectations when the legislation was passed. So a lot of support for the legislation itself, at least from one side of Congress. But I think it'd be it's kind of a tough story to get rid of now, at least by fiat, regardless of how this next election goes. I think the program has legs. It did need to be rounded out because I think it was 4 pages inside of the Tax Cuts and Jobs Act that kind of got slipped in. And again, it's taken 3 rounds of clarification, particularly with the tax. I don't think there's any CPAs in the room, but CPAs get pretty deep on this stuff. Like, there's a lot of nuance and acronyms and issues that they needed to really work through in terms of, what types of entities can generate the gain, and when you had to recognize the gain, and when you had to deploy the capital. But like I said, as of December, the rules are really pretty clear. So I hope this was helpful. I'm happy to answer questions. I don't know if it's timing right.
Yep.
All right.
We have until 9.
Till 9.
Yep.
All right. Ask lots of questions. What did I miss? What can I clarify further? Can I say?
Sure.
Of the 2 projects you showed 16 IRR roughly. Is that a 10-year? Is that a 10-year IRR?
That's they're underwriting, yes, to a 10-year IRR for fund investment. So, it's important, right, that those IRRs are independent of the cost of capital.
That's right.
So again, they can make a good deal great, but they aren't going to make a bad deal good.
Right.
And I think that's a critical piece, because just out trying to raise capital from investors of all types, I can tell you it's a different conversation, obviously, with a real estate guy than a guy who sold, the low basis position in Coca-Cola or UPS or his business. And the funny thing with real estate people, the biggest issue we're running into is that people like to underwrite. In real estate, they like to touch and feel it, right? And so you talk to the real estate guys, and they'll go through our deck and our due diligence, and they'll go, well, we want to do that deal, but we don't want to be in the fund. So we've had those conversations. It's just kind of a wild, wild west right now in terms of how this capital formation is happening, and we're hoping that there's more discipline coming. But it's tough to convince a real estate family. We had a conversation with a family office from Florida, family office, but really they're real estate family, multi-generation real estate. They had sold a business that sold a building that granddad had invested in like 1962. It was the first transaction since 1962. So they'd blown through all of their 1031 exchange capacity, had about $5 million left over. And they saw our website, liked our premise and thesis and story, and they loved it. And then in the end, they just couldn't pull the trigger on being in a diversified fund. They wanted to buy Fayetteville. Like, we want that project. We could do that, but then our business has changed, right? So the real estate, I think the real estate element is going to be the first layer, and then you're going to have a more diversified investment base that really takes advantage of the tax advantages of the program, because they're substantial. I mean, they really are, and you have a lot of conversations of, well, you got to lock your money up for 10 years. Well, there's starting to be ways around that, and if they're good investments, it's a good way to diversify. I think the futures were up another 1.5% this morning. So the stock market hasn't helped, right, in terms of capital development, because there hasn't been enough fear created by the overall market. 16% IRRs don't look so great with the S&P 500 screen, right? So there's other market dynamics behind capital raising in this business as well. But yeah, so we think 16% IRRs is pretty good real estate.
And for 10 years, it's really good.
Yeah. Yeah.
Especially in real estate.
Yeah.
Create all your value, like you said, in the first 3 years.
Right. And we may end up holding that project. So we keep the option of holding it because we think the yields on that will actually be 10% plus, I think is what the yields were, with a decent exit multiple as well. So we have that option to hold property inside the fund and take all those tax benefits. But in general, we want to, the Manchester Hotel yield, I think, was 8%. You're going to get market rates plus. So it probably makes more sense to sell that property when you get the bid from another Hilton franchisor or franchisee, another management outfit. If someone was to buy that property, and it makes fiduciary sense from an investment perspective, the program should allow you to maintain your tax advantages. And they've really clarified that. There was some real confusion about how you could distribute gains back out. And when you have what's called an inclusion event, which is another thing the CPAs get really bogged down in, because there are tripwires in terms of how much you can distribute relative to your invested basis that you really have to be careful with. Gifting, like divorce, like people have to work through all of these inclusion events an inclusion event basically means you've got to recognize the gain today, right? Rather than having it deferred to 2026, rather than having the capital gain reduced after 5 years, you can trip that up and lose the tax benefit, which, again, if it's a good investment, that's not the end of the world, but, if you're going to commit, you want to make sure you preserve the tax benefits, particularly that last one. So we think the 10-year hold is important to be in it till that last bite of the apple occurs, because you'll get a big bump, right? I presume even if in 2029 or 30, Elizabeth Warren had her way and we have a 50% capital gap, at least it'll be hopefully the program will be preserved and you'll not have to pay those taxes.
Is there anything in the statute that would protect this program from being just undone legislatively?
No, there's no.
I don't know that you can. I don't know.
Yeah, I think one of the squad members attacked it to eliminate it completely. I think she got rebuffed pretty quickly. I think it's Talib. I think was in the press saying this is a giveaway, another giveaway to wealthy developers. Right? Yeah, obviously it's a pretty easy argument to make, but as long as the program proves out again, like as long as you have community development that works, you create jobs, you expand the economic base and the tax base inside of the communities that the projects are committed to. It's a great, just like the conservation easement program. We can talk about that, right? There are public goods being created that do create tax advantages for wealthier investors, but we think there's a greater good argument that can easily be made if it's managed appropriately, properly. There will be bad actors, obviously, but bad actors won't set the market. The legislation won't last if there's only bad actors developing, right? So if we give ourselves the benefit of the doubt, people in this room and elsewhere, that we're responsible allocators of capital, the program really has merit. But yeah, there's nothing, the politics will always be the politics. I think it's one of those things where it was slipped in and people are going, wait a minute, what does this mean? And where can we score some points? So, any other questions or thoughts?
Thanks so
Well, I
much.
appreciate it. I didn't take it to 9 o'clock, Katie, but quick is better. But I appreciate y'all having me. And feel free to, I know, Katie, this is going to be available online. And I'm happy to send our presentation slides to anybody who needs them, but they'll be available on the Sterling Seacrest website. And I'm happy to talk to anybody offline. You want to contact us. So thank you. Thank you, Doug.
Thank you very much.
I apologize for arriving so late, but if you enjoyed today's program, which I'm sure you did, and if you happen to take a look at this, we sort of take a holistic approach. We're a risk management and insurance firm, but if all we did was talk about risk management and insurance. Nobody would ever come to these programs. And so we take sort of a holistic approach to risk and opportunity. And this is an example of that. And you can see from the placemats that we sort of cover a wide gamut of topics with these programs. We've been doing them for about 6 years. And I promise that was the first time I was ever late. I'm so sorry. You know, if you enjoyed today's program, make sure that we have your contact information, because I know some of you came as guests of invitees, but these are never, you know, they're always for free. It's a wide variety of topics. We love to see people come out once or twice a year. We think we're adding value if we're doing that. We have some folks that come out half a dozen times every year. It's totally up to you. There's never any pressure. And, you know, if you ever want to be removed from our list, all you have to do is let us know. We don't ever want this to be any kind of aggravation, but we appreciate you making the time to come across town. We are working on some additional program scheduling, but we do have one set for April 29th. We're going to have some folks come in from a well-known construction law firm in town and talk to us about lien laws. And this is something that we're hearing a lot about. You know, some of you folks today, I'm sure, because you came for this topic, right, are in real estate. And we happen to do a lot of bonding, so we're constantly in the middle of liens and disputes and so forth. So there's, you know, this is a particular area of the law that, you know, if you don't follow it precisely, it can come back to haunt you. So, you know, if that's of interest, be on the lookout for an invitation. It's scheduled for a breakfast session on April 29th. But we'll be adding to the program and pushing out additional invitations. So look for those. Thanks so much. What you say?